Imagine opening your stock app and seeing a brand new ticker about to appear. No long price chart, no famous brand, just a name, a range, and a promise that the business might be worth watching. That's Coolbit Technologies, and on the cursor stocks, the question is simple. What would have to be true for this IPO to make sense? The company is Coolbit Technologies Ltd, expected to trade under CBAI, the short stock market nickname people use to find it. It's set to list on the NASDAQ on June 22, 2026. The deal is still pending, so treat the numbers as the current plan, not a finished result. An IPO is the moment a private company starts selling pieces of itself on the stock market. Those pieces are shares, tiny ownership slices of the company. Coolbit is aiming for a price range between $4 and $5 per share, which sounds small, but share price alone never tells you whether a stock is cheap. The plan is to offer 5 million shares and raise about $25 million. Divide the raise by the shares, and the expected price works out to around $5 a share while the deal is still pending. So this is not a giant household name listing. It's a smaller IPO, asking public investors for growth money. Why would a company go public at all? Usually it wants cash to grow, more visibility, and sometimes a path for early backers to sell later. But the useful question is the same as when a new ticker pops up in your app. Can this company turn the attention and the money into a stronger business? Here's the unusual part. You probably don't have a Coolbit product in your pocket, and the current public profile doesn't clearly explain what the company sells, who buys it, or why customers need it. That missing everyday link matters, because a stock is not just a ticker, it's a claim on a real business. So before getting excited, pause on the basic business story. If Coolbit sells software, investors need to know whether customers renew. If it sells hardware, they need to know whether making it is expensive. If it sells services, they need to know whether revenue repeats. Right now, those pieces are not clearly visible. That brings us back to the central question. What would have to be true for this IPO to make sense? At minimum, Coolbit needs to show a product people understand, customers who pay, and a reason those customers might keep paying. Without that, the $25 million raise is easier to describe than the business itself. Market cap means what the whole company is worth on the stock market. For Coolbit, that full IPO valuation has not been set yet. That's important because a $5 stock can still be expensive if there are a lot of shares behind it. The price tag is bigger than the number you see first. Think of the stock app screen again. It may show price first, but investors need the layers underneath: the full valuation, the revenue, the profit, and the share count. Coolbit gives us the offer range and the planned raise, but the whole company price tag is still blank. Revenue is the money coming in before expenses. Profit is what's left after the bills are paid. Coolbit's latest full-year revenue and net income are not available in the current public terms, so the financial reality is mostly a warning. You can't judge momentum until the company shows the scoreboard. The bull case has to stay careful. A $25 million raise could be useful if Coolbit has a real product, paying customers, and a market where more cash helps it move faster. The hopeful version is that a quiet business is about to become easier to see, but hope is not the same thing as proof. Even the price range shows why small IPOs can move quickly. At $4 per share, 5 million shares would bring in about $20 million before fees. At $5, it reaches the planned $25 million deal size. For a smaller company, that difference can mean real extra fuel. That sounds promising. But here's the catch. When the company story is thin, public investors are being asked to accept more uncertainty up front. Maybe a fuller prospectus fills in the product, customers, and leadership. Maybe it doesn't. Until then, you may be pricing a company before you really understand it. Competition is another place where guessing would be fake precision. Until Coolbit clearly says what it sells, naming rivals would only make the story sound more certain than it is. Every business has alternatives, though. Sometimes the rival is another company, and sometimes it's the customer deciding not to spend at all. The people behind the company matter too. A CEO, headquarters, founding year, and operating history help investors decide whether this is a proven team or just a new name. Those details are not clearly available in the current profile, so credibility has to be earned through documents, customers, and execution after listing. There's also the question of who gets the IPO money. Sometimes new shares send cash into the business. Sometimes selling shareholders cash out. And a lockup, a waiting period when early insiders usually can't sell, can affect supply later. For Coolbit, those details are key follow-up items, not assumptions. After it lists, watch 3 simple signals. First, does Coolbit explain what it sells and who buys it? Second, does it show real revenue and whether losses are manageable? Third, does management use the IPO cash to build something measurable? Those answers matter more than the first-day stock move. So the balanced verdict is this. Coolbit's IPO is understandable as a small public raise, but the business story still needs to become much clearer. The dream is that investors are seeing an early company before the crowd does. The doubt is that too many basic pieces are still blank. Next time a new ticker appears in your stock app, you know what to ask. What does it sell? Who pays? What are the numbers? And what could break? Follow the cursor stocks for IPO stories before they trade. This video is for information and education only, not financial advice.